Good morning. Quick update for everyone. Hope you're all well as we continue to work through the unprecedented strangeness that's rolling through the globe these days. I've gotten a few questions as it relates to this current market and its bounces that it's been giving. Make no mistake, these are still nothing more than bear market bounces, and I want to share a few slides with you to give you some perspective on why I believe that to be true. We continue to see the global environment very heavily steeped in a deep recessionary type of an environment where we have slowing growth and slowing inflation across the board. And remember, we're just getting into the beginning stages of earnings season where most of these companies that are going to come out and report are basically saying we're going to withdraw guidance, meaning they have no idea what to tell people as it relates to their overall business and their expectations with regards to earnings moving forward. Some pockets of the economy obviously have the opportunity to do a little bit better when you're in the midst of a global shutdown, but the fact remains that there is essentially very little, if any, economic activity happening, and I think that sometimes is lost on the day-to-day noise that you get from financial TV screaming about how much the market has been up over the past couple of weeks. So remember, you can get some very strong moves to the upside in the midst of a bear market, but we have to constantly follow a three element model: price, volume, volatility. And the last one being one of the most important elements of identifying whether or not you can be long or own an asset within that particular volatility regime. And so therefore, if we have, for equities, for example, volatility north of 31 as identified by the VIX, then that's an uninvestable bucket. We're still at 43, roughly 44, 45 on the VIX in a very what we would call bullish trend for volatility, meaning we would anticipate volatility to accelerate, which is not what you want to have to become an investable environment for stocks once again. The two bull markets that exist currently are in treasuries and in gold. We've been patiently waiting for opportunities to slide into some of the positioning within long-term treasuries and maybe even gold, but that's been a very difficult environment too. Only because, for example, gold volatility continues to be very elevated. And just recently, the MOVE index, which quantifies the volatility of the bond market and the treasury market, has started to come in to the point where it's making that asset class investable again. So we're attempting to get a position in longer-term treasuries today before we see some of the, I think, very heavily deflationary reports come out tomorrow and Friday. We'll see how that goes, but I'm not going to chase anything in this kind of an environment. We do have some short positions currently on that were made at yesterday's open, which was an epic bear market bounce right at the open. And it was obviously very interesting. The market, as identified by the Dow, for example, was up at one point roughly 1,000 points, and it completely faded into slight red by the end of the day. That, in our opinion, is showing that we're very close to the top end of the current range. On a daily basis, I get a mathematical model that helps me to identify the probable range of movement for any of the major markets. And yesterday, when we shorted the S&P, the NASDAQ, and the Russell 2000, we did so at the very top end of that range. This morning, the mathematical model was showing roughly a 10% downside probability and roughly a 2% upside probability. So clearly, the probabilities lie in our favor as it relates to seeing this market pull back some. We take very small positions. We'll start with maybe a 1% position, 2% position, and if we get the range that we really like on the upside, we might throw in an additional percentage for a top 3% position per short. That's as most as I'm going to go in any of those environments. And we'll see how it works out. But I really do think that if we get some of the things that I think are coming down the road as it relates to earnings and all those things, it's going to show that this economic environment is just very deeply in a heavily structured growth slowdown and inflation slowdown. And so far, consensus perma bulls from Wall Street just have not believed it. And so therefore, we continue to see a number of the companies that have been, quote, story stocks continuing to move up. really for no good reason. Story stocks, what do I mean by that? The FANGs, right? Facebook, Amazon, Apple, Netflix, Microsoft, Google. All of these companies are what we would refer to as bubble companies, story stocks within the last move. One of the things that you'll always see within a bear market is a change in leadership. And we've not seen that change in leadership yet. So in other words, the second phase of a crash, which has a tendency to literally eviscerate all the bubble stocks and the story companies, hasn't happened yet. And one of the things that you don't want to do in the middle of a bear market is own everything that everyone else owns. Well, if you look at the top 20 positions of most large cap mutual funds, you're going to find all those story stocks: Visa, MasterCard, Amazon, Apple, Netflix, Microsoft, Facebook, Google, all of them. They're all in those top 20 or so positions in varying degrees. So it's my opinion that, and others with a much smarter pay grade than me, that are of opinion right now that you go against consensus and number one, not own any of those things, and number two, anticipate them to really get hit on the downside. So I'm going to share a few screens with you, give you a few slides, continue to just share some basic updates on why I continue to, at this juncture, be bearish. And recognize, too, that when things shift, we'll know. There will be plenty of clues that major institutional movements will give us to help to identify when it is, in fact, time to become bullish again. What's nice is that we're in the lead, right? We have a gain in the midst of an epic crash, which gives us the opportunity to not have to worry about catching a falling knife. We don't have to pick a bottom. And so I'm not going to attempt to do that. That's a fool's game. What we want to do is just catch the meat of the next bull run. And it'll come. And it'll probably be pretty strong. The strongest bulls always come out of the worst bears. So we'll see where that goes. But let me share my screens with you real quick with a couple of basic elements. This is a chart of essentially sentiment, and one of the things you do not see at a bear market bottom is this. Everybody expecting stock prices to be higher a year from now. You have to remember, in the midst of a bear market low, what you're going to have, instead of a bunch of people excited about wanting to buy stocks because the expectation is the prices are higher a year from now, they're literally going to be, well, in a corner in a fetal position, just ridiculously sick at the fact that they can't imagine how much money they lost. That's what happens at a bear market bottom. And one of the things, too, just to recognize is that one of the things that makes bear markets really, really problematic isn't necessarily the bear market move itself, although that's bad enough. What makes it bad is people get bigger on the way down, meaning they size up their positions on all these bear market bounces that take place. So it's bad enough to go through a bear market drop, but what most people do is they decide they want to buy or chase the market because all the Wall Street and all the cowbell and all the signs that so many people on financial TV want to drag you into the market are just, it's noisy. And so unfortunately, that's one of the things that happens. So back to the screens again one more time here. So the next one I want to share with you is just, and this is super busy. If you want to pause the video and take a deeper look at this, that's fine. This is just a much longer term look at multiples as defined by CAPE, which is the cyclically adjusted PE ratio. And so when you do that, you can see that here we are in February, March of this year up in this range. However, if we were to get PE ratios consistent with the markets that existed in the last two major bear markets that we experienced, which obviously were the 2000, 2002 cycle, 2007, 2009 cycle, we're going to need to see somewhere between a 20 to 30% additional drop in this market. And if that happened, we'd see about 2,100 on the S&P 500. We'll see if that happens, but I think the possibilities and probabilities certainly weigh more heavily on the downside. Some of that is identified by some of the current research that's coming out. This is from Credit Suisse of just a couple of days ago. And basically what they're showing is that the current S&P 500 trailing 12-month PE ratio is currently at a level, based on its estimates, based on earnings, which I think are using that are using wrong numbers, are at levels that were consistent with when stocks were at these highs. That doesn't that doesn't compute to being bullish at the end of the day. So we got to be careful of that. And this is one of the main reasons why we feel the bearishness that we do. What is this? This is a picture of initial jobless claims of the most recent number that came out last Thursday. Remember, we get another number tomorrow. It's probably going to continue to be terrible. The last non-farm payroll number that came out last Friday, which is distributed monthly, was down 701,000 jobs. But what you need to remember is that only took into consideration the job reporting elements through March 12th. That doesn't take into consideration these initial jobless claims of the last 2 weeks that are up almost 10 million. So the next jobless report that comes out in April for the full March guide, or excuse me, in May for the full March into beginning April guideline is going to be horrendous. Lots of things can happen between now and then, to be sure, but the numbers are going to be terrible because it's going to reflect this. And, look, this goes all the way back to 66. We've never seen anything like this before. This is uncharted territory as that relates. One of the things that is continuing to be problematic is just expectations. Remember, one of the things I said about this whole virus well over a month ago is that it is changing both personal and corporate behaviors. Some of it, obviously, being forced by all the stay-at-home orders that are being issued throughout various states within the country. And obviously being enforced. Police officers are certainly rolling around, and if they see kids congregating within a park or somewhere like that, they're asking them to go home. If people are just out and about, doing anything that looks like it's a congregation, they're not allowing that. But at any rate, look at the small business sales expectations. I mean, it just completely fallen off the grid. And a lot of that has to do with this. Consumers and businesses have no cushion. 55% of all small businesses cannot survive a 3-month shutdown. Now think of the implications of that. And when you take it into the personal level, 53% of all households have essentially no emergency savings. It's a huge unfortunate scenario, but that's the reality of where we're at. So, given where we are, even if people have the capacity to go out and spend some excess savings, not a lot of people have excess savings. So do we really think that the demand curve is just going to completely fly back to where it was pre-virus? I think that's wishful thinking, but we'll see. One of the biggest problems that exists with consensus permabulls, which is always old Wall Street, is look at the expectations that they still have for earnings going into the second, third, fourth quarter, and first quarter of 2021. I mean, really? We are experiencing epic deflation. We're experiencing epic jobless claims. We're experiencing an epic shutdown of global businesses on a scale that none of us alive have ever endured or experienced. And we want to believe that S&P 500 suggests that we're going to see this kind of an earning curve for the remaining 3 quarters. They're only calling for a drop of 1.6% earnings numbers for Q2. I'm not sure what these guys are taking or smoking, but it's clearly causing them to be delirious. So we'll take the other side of that. We've got to remember, bear markets are a process. They're just not a specific point. And again, there's a lot of busyness happening on this chart. If you want to hit pause and look at it later in more detail, you can. But the only thing I want to point out as we look at some of these previous recessionary bear markets is this initial jobless claims number. The median on this was 91%. We've experienced a 1,500% increase in this number, and yet at the same time, headline unemployment has essentially been unchanged. That makes no sense. And when we compare max drawdowns and durations of bear markets, historically, they don't happen just when the government steps in with massive forms of bailout money and things of that nature. They happen over time. And many have compared this current slowdown / shutdown and recessionary type bear environment with what was experienced back during 29 and 32. Let's not forget the kind of risk that existed back then as it relates to a drawdown in equities and the duration that it took place. I mean, if we look at the S&P 500's earnings expectations here, you'd anticipate them to think that we're just 1 month, 1.5, 2 months into this thing and that's it. But yet the average has been easily 20 to 21 months over a period of time. Again, think that the permeable expectations on Wall Street these days are just wrong, just straight up wrong. The mortgage market continues to be a mess. A lot of it has to do with delays, forbearances, and things of that nature. I did a radio show this last week, and I talked a little bit more in depth about one of the problems within the mortgage market that had to deal with mortgage servicers. I'm not going to bore you with that here today, but if you go to our website, careformywealth.com, click on resources and click on podcasts, you can listen to last week's radio show, which was on Saturday. And towards the end of the program, I spent about 4, 5, 6 minutes specifically talking about why the mortgage market is an abject train wreck right now. And it has a lot to do with the way the current servicers are set up and how they run their businesses and some of the problems that are coming to them in that regard. So the last thing I want to share with you is the typical movement of both bull and bear markets. And I am of firm belief that we're right in this range right here. Because what we've had is this blow off kind of a growth element that hit a top on February 19th, and there was obviously some denial by many people as the market started to collapse. We are in this thing that I think is called a bull trap, and time will tell to see if that's accurate or not. But yesterday's fade into the close helps to certainly support that. Once we start seeing some of these earnings numbers come in, that'll help support that. I mentioned Visa MasterCard as one of the top 20 positions within the vast majority of large cap mutual funds on the market today. And one of the things that you don't hear about is the fact that they've seen their transaction rates completely collapse. MasterCard reported the other day a 60% decline in transaction rates. Now think about that. One of the other things that they don't talk about are their charge-off rates. So typically when you get an increase of approximately 1 million unemployment claims, then you see about a 1.6% charge-off. Well, we've got about a 10 million unemployment claim number rolling around, which suggests Visa MasterCard are probably going to have somewhere to the tune of 20% charge-offs. Now think about how that might affect their business. They've seen a reduction of 50 to 60% in transaction rates, which is indicative of current shutdown in global economic activity, and they're going to end up with a charge-off because people can't pay the bill. I'm just not sure how that is bullish for a mutual fund that owns those companies, and believe me, they still do. You can look at them inside if you want, but at any rate, this will pass. It's going to take some time. I don't believe that this is over yet. I do believe that because the vast majority of people expect the worst to be behind us, I think that consensus is wrong. I think that once we start to see the earnings numbers coming in, they're going to be a bit shocking. And it's just not going to fix itself overnight. Even when the stay-at-home orders are lifted, how many people are going to want to rush back into the public sphere amidst the fear that this thing has placed on so many people? I mean, I've never seen anything like it. I think there's a lot of things to be afraid of in the world, but this scenario has played out in ways that I think is just it's not just unprecedented. So we have to remember, I'm not so sure economic activity is just going to completely come charging back, and I think the likelihood of a V-bottom is very unlikely at this point. Eventually, we'll get a stock market bottom. Eventually, we'll get an all-clear signal that it's time to be bullish again, and once that happens, then we'll be very, very heavily long of a number of items that would make sense within the economic quadrant we believe to be in at that time. So until then, we'll continue to jump in and out of short positions. We'll continue to hold our U.S. dollar position, and we'll continue to build a position in U.S. Treasuries as that volatility index has come down and made that sector investable again. And notice I said Treasuries. I didn't say corporate credit. Typical fixed income / corporate credit is still in a serious bear market, and there are serious problems that are going to develop yet in that sector as major corporations recognize they've got too much debt, they can't pay it off, and we're not sure how that ends up playing out. But corporate credit is not something to be holding right now, in my opinion. When I say corporate credit, I mean typical bond funds that are not focused on just treasuries. So if you have any questions, give me a call or shoot me an email, 608-354-1977, chris@careformywealth.com. Always thankful to work for you. Always appreciative of any questions or comments that come in on these videos or anything else. It's a strange time, so there's no such thing as silly questions. Always look forward to hearing from you. God bless. Have a great day.